If you've been struggling in your trading as of late or since the inception of your trading career, it's very likely that you are committing at least one, if not maybe all three of the trading mistakes that you need to avoid, which I'm going to go over in this video. Now, these mistakes are very easy to stop doing, and you can immediately implement the advice that I'm going to give in this video in order for you to immediately start increasing your win rate, filtering out all those low probability trades that you're currently taking. So let's just get right into it. Mistake number one, ignoring market context. So this often happens to traders who just simply forget to zoom out. The higher time frame always rules. It is the stronger magnet for price. So for example, if you have a 1 hour for value gap right here pointing lower, and you're just looking at the 1 hour time frame, completely oblivious to everything that's happening above you, you're going to get blindsided, because what do we have right above? A 4 hour for value gap, and price is going to trade into that 4 hour for value gap first before moving lower. It's not going to move lower off of this 1 hour. It's going to move lower off of the higher time frame, because remember, the higher the time frame, the stronger of a magnet it is going to be on price. So if there's a higher time frame for a value gap above price, above the time frame you're looking at, all these lower time frame premium arrays below it are lower probability, and we expect those to fail as price will seek the higher time frame imbalance right there. So the higher the time frame, the stronger the zone. A 1 hour is going to be subordinate to the 4 hour. A 4 hour is going to be subordinate to the daily. A daily is going to be subordinate to a weekly, and a weekly is going to be subordinate to the monthly. So before entering a trade, don't just look at the fair value gaps on your entry time frames. You need to always look at the time frames above you first to make sure everything is in alignment. So let's take a look at a real example here. We're on GBP CAD 4 hour chart, and we see a 4 hour fair value gap you might want to look long off of, right? We have been very bullish. Let's just continue longing off the 4 hour fair value gaps. Why not? Well, the reason not is because you didn't check the higher time frame. You didn't check the daily, which if we turn the daily back on my indicator, which automatically marks all your higher time frame for value gaps above the one you're looking at, you'll see that below this 4 hour gap, we have a daily for value gap, which if we go to the daily chart right here, you will notice that daily for value gap right here. So what is price going to do? It's going to gravitate towards that daily for value gap and look to move higher off of that. So back on the 4 hour, let's just see how this played out. 4 hour for value gap fails. It's low probability. We come down into that daily and we move higher off of that. Mistake number two, no confirmation. So for me, entering trades way too early made me lose a lot of money in the past. I would jump the gun and sort of just impulsively enter without getting my proper entry function. So now I always wait for proper confirmation from my higher time frame for value gaps, my higher time frame PD arrays, and for that, I prefer to use fair value gaps. Fair value gaps in the form of an impulse shift. So I made a video on this not too long ago. I will link it up here, but just a quick rundown. Once price comes into a point of interest, I'm looking for a fair value gap displacing away. So right here, there is no fair value gap displacing away. So no fair value gap means no entry. I want to see price come into a PD array, create a 15-minute gap depending on the time frame alignment, which we will go over right here. It's not just about waiting for any random fair value gap, right? You need to look for it based on the proper time frame alignment. So if price comes into a monthly fair value gap, a monthly PDA, I'm looking for a daily fair value gap displacing away. Off a weekly, I'm looking for a 4 hour. Off a daily, I'm looking for a 1 hour. Off a 4 hour, I'm looking for a 15-minute. 1 hour, 5 minute, 15 minute, 1 minute. So let's go over an example on New Zealand JPY, where we have very clean daily context to the downside, daily push context. If we're going to move lower, we're going to move lower off of this daily for value gap to then seek this daily ERL. So this is IRL to ERL, again, otherwise known as push context. So now that we know where we need to go down into the lower time frames, this is where we look for a confirmation inside that daily gap. So diving down into the 1 hour, we know we're looking for a 1 hour for value gap out of that daily, a 1 hour impulse shift. So let's just wait and move forward in price to when we actually see that. We see no impulse shift just yet. If you would have shorted here, you would have taken a loss. There was no signal. There was no confirmation. This is why we need to wait for the proper confirmation. So price comes in back into that daily gap, sweeps this buy side liquidity, and now we have that 1 hour impulse shift right there. So now we have confirmation. Now we can place an entry. We can take an entry right at that 1 hour gap, put a stop loss at the swing highs, and target a 2R right there. And let's just see how that plays out. Beautiful. Mistake number 3, trading weak pairs. So when you're trading, it is in your best interest to always trade the strongest asset. For example, if you're bullish, you want to trade the most bullish asset, the most strong asset. If you're bearish, you want to trade the opposite. You want to trade the most weak asset. Now, in order to determine the strength of a pair, we need to understand the correlated pairs, right? So there's two types of correlation. We have positive and negative. Positive are two pairs that move in the same direction. So for Forex, these are your positively correlated pairs. Euro is positively correlated to GBP, AUD to NZD, and dollar to these USD base currencies right there. Indices, NQ and ES, NQ and YM, ES and YM, and then commodities, oil and natural gas, and silver and gold are positively correlated. And some negative correlated assets, we have the dollar with USD quote currencies right here. Now they'll move inverse of that, and the indices right here. Now a word on this, me personally, when I'm trading, I don't factor in dollar analysis to when I'm trading indices. I notice that typically that does more harm than good, and they aren't always as one-to-one as dollar is, for example, with the majors right here, where then I am very on top of what dollar is doing in order to trade the majors. But for indices, honestly, I do not look at dollar at all when doing indices analysis. So keep that in mind. I think that is pretty helpful tip. So now that we know that we want to be trading the strongest asset or the weakest asset, depending on if we're bullish or bearish, how can you actually pick which pair? Well, one way to do that is by using SMT, short for smart money technique. And in order to utilize SMT, we need to understand that price only reverses in two ways. We have failure swings, which is when price is so weak, it cannot even reach that liquidity. Hence, it will move much faster lower than, for example, a breaker swing. So if you see a failure swing right here and you're looking for shorts, that is your weaker asset. If you see a failure swing right here on the lows and you're looking for longs, this is your stronger asset. Whereas on the other hand, breaker swings, price is strong enough to actually move above and take that liquidity before reversing. Hence, it will move slower compared to the failure swing. So this right here, if you're looking for shorts, this is going to be the one you want to avoid. And this, if you're looking for longs, the breaker swing is going to be the one you want to avoid and opt for whichever pair made the failure swing. So trade the failure swing, don't trade the breaker swing. Let's say we want to short the market and we have two pairs in the same direction, positive correlation. We always trade the failure swing, the fastest price action. So let's take a look at an example of a real trade I took on GU here, where if we look at the left, we have euro dollar, and euro dollar has just traded into a daily fair value gap right here. And GU on the right has not. For reference, if we go to the daily chart, the daily fair value gaps I'm talking about are these right here. This daily fair value gap on euro and this daily fair value gap on GU, in which if we look at euro, we took that candle's low, which created the fair value gap, and over here we did not. So there's a failure swing right there on GU. So let's go back to the 1 hour, and we'll notice that on GU we have created that 1 hour impulse shift. That's that 1 hour fair value gap displacing away, because what happened is that SMT qualifies this as price tagging into our daily fair value gap, so we can look for an entry inside of that 1 hour right there. Put your stop loss at the swing low bodies and just target a static 2R. And this is valid SMT. We're trading the stronger asset right here, which is GU. And let's see how that ended up playing out. Hitting 2R, completing context, hitting ERL right over there. Meanwhile, if you look at the left, GU did absolutely nothing during that time. That is the lower probability asset, the weaker asset. That is a trade you want to not take when we don't even get the proper confirmation on euro. Again, this is a great example of why you always want to focus on the stronger asset. Implement everything we went over in today's video, starting on your next trade, because these are very simple mistakes that you can stop doing immediately and implement right now. Remember, what did we go over? Mistake number 1, ignoring market context, making sure that every time frame is in alignment with a time frame above it. Mistake 2, waiting for your proper confirmation, not jumping the gun, being patient, wait for your entry function to be crystal clear in price. All right. Mistake number 3 is trading the weaker asset. Trade the one that has, if you want to use SMT, that works. Also, you're not just limited to SMT. You can use simply an eye test. What has more arguments going for it? What is looking visually stronger via the candlestick logic video that we went over, the candles, respect candles, disrespect candles, how big are certain fair value gaps, all stuff that I've actually covered in a previous video a while back. So if you want to check that one out, go check that one out. I believe it was called low probability trading, how to spot low probability trades, something along those lines. But you're not just limited to SMT, although it is a great tool to spot the weaker or stronger pairs. But anyways, guys, I hope this video was insightful. Let me know in the comments below if you have been committing any of these 3 mistakes, and update me with your progress. You know, I'm always in the comments. I read every single comment. So I'm very interested in your stories and your progress with the videos. If they're helping, that's very insightful to me. I really care about your guys' progress. So let me know about everything that you're up to. I see it all. If you're interested in the indicator that was used in this video, my custom indicator right here, which marked out all the relevant fair value gaps, all the fair value gaps on the time frames above, which actually makes it impossible to commit mistake number 1 again, ignoring market context and be blindsided because you're not checking the higher time frames. This indicator does that for you, along with a huge list of other very, very nice things. It's not just a fair value gap indicator. It is a powerhouse of the tool, and I cannot trade now without it. It has saved me so much time, so much brain points, so I can focus more on just actual execution and the things that matter. So I highly recommend taking a look at that. You can find that at sirpickle.com. Sirpickle, look at that. sirpickle.com/indicators. And I will keep that link in the description as well, so you can just visit it right there. We're having 30% off your first month using code March25. So check that out. Thank you for staying until the end of the video. I'll see you in the next one. Peace out, fam.